Welcome back to the channel. We're going over the SP 500, the Nasdaq 100, and exactly what's happening with the stock market. I thought we were supposed to be bouncing. I thought we were going to reach new highs, but it looks like the bears are still in control. Like, subscribe, do what you got to do. Let's get to it. Now, the first thing I want to go over is the charts, and I have some big news at the end of the video regarding the market and new data that just came out. We're going to get to later on. But as of right now, what is the data pointing to as we speak? So we can see yesterday, this is where you ended at that triple top. What I said from this, what was going to happen? What did I anticipate from this until more news and data was released? Regarding this, I said you most likely were going to ping pong in this range back and forth if no new data was released or until some data was released regarding inflation numbers, things like that. Now we have CPI data coming out early next week. So getting this pushed down is a little bit suspect how quickly we did run up. It could have been shorts covering yesterday and then overall options expirations coming out on the S&P, but you're seeing a little bit of a bounce at that monthly level on the S&P right now. But what I want to highlight is the only way you were going to see more upside, or the only way I was leaning towards calls, is if you broke above this range. Why? Because we always are playing the break, retest, and then push up. That's how you want to play this. So you don't want to get longs going against it. It just isn't worth it as you have that triple top. And this is now a major resistance. And you can see acting very strongly against this. If you go to the Nasdaq and how that's responding, you are already back near those lows. You are very dangerously close to hitting back at those key levels. Just highlighting where exactly those are. You are roughly in that range already at 12.8, and then the actual lows are about 12.714. So you got very close to getting back exactly where you were 3 days ago before you even started getting this bounce from that Fed rate decision. So you got the 50 BPS hike. We know that's still not good for the economy. As we look at the yields and at the bonds, what is the 10-year doing? Again, I mentioned this to you yesterday. This is what was going to happen. You had a little bit of a dip, but boom, you're shooting right back to these highs, and you are almost past 2018 highs. As we zoom out here, go to the daily very quickly, you can see these are your 2018 highs. You're getting there right now, and you're going to hit there very quick. This is basically since the beginning of these hikes right here. You've gone from 1.8 all the way to 3.1 roughly, and going back to 2008, you can see you're getting back into that region. Once you get above almost 3.8, 3.9, you're in 2008 region. Going back to the actual conversion, this is what indicates typically the leading indicator to that recession that we're always talking about. Look what's happening. You're flagging, pushing right back up. The conversion rate still very high, 0.97. All yields are spiking on this news, but I anticipate to see the 30-year come down a little bit and the inversion to be complete. So you're seeing, yes, you're right back there at the 05, 07 levels before the 08 crash. You're back at those levels and back at the dot-com bubble in 2000 roughly to when that happened. But this is the big news that I wanted to talk about. And we were just talking about this in our Discord and what is going on currently with the economy. Now, we had some day trades going on, but this news was pretty interesting. If you don't know, we've been talking about the mortgage rates and what's happening with the housing market and how the housing market is most likely in an inverted bubble, if you will. And when I say an inverted market, it's not your typical housing bubble, if you will. I don't believe people with homesteads, your primary place of living, are going to lose their homes. I think they will be shocked by the price they're going to be paying on their rates, but you're seeing this happening right now. The ARM nationally is sitting at around 13% of all mortgages. That is extremely high, 3 times higher than January 2021, because everyone are buying these homes. And this is the key part. And most of them got these with the expectation of under 5%. And those rates are now bumping up over 5% as we speak, rising over 2.5% in just the 5 beginning months of this year. You can go into all this data regarding that, but the key thing they're pointing out here regarding this data, that the average credit score, and it would appear to be less risky for these banks, is because that credit score is around 657. But you also know the credit limit nationwide is now at all-time highs. There's people with no money in their savings account, so once this starts to really tip over the edge and rates get too high here, in my opinion, you're going to start seeing this credit rating really start to drop. So that's the real question, is how does this go? And so when you go back to the 08, 05 like leading into that crash, you have to go back to how the credit score was then, and it was about a 640, which is still considered an okay credit score, but you can still see these weren't major indicators of a massive downturn. 757 is significantly higher, I get it, but we're in a region where you felt pretty safe with the average credit score on those ARMs being at those levels. The ARMs are going to continue to rise as well. This is very, very big. Going into the recession, 60% of ARMs originated in 2007 were low and no documentation loans compared to 40% of the FRMs. That's very important to know because you're getting a very, very big similarity when it comes to the ARMs now and you did back in 07, 05. But this is the main key difference is based on those credit limits and credit scores right now. So this is very big. The number of outstanding ARMs is at its lowest in 20 years. That is worth noting. So no one's actually behind on those payments yet. So you're not seeing a backlog of effects into the market yet. That's the important thing to know. But having 1.4 million active ARMs are very, very daunting when you look at the broad scale and how this could easily get out of hand. Just so you know, ARM, it's adjustable rate mortgages. Is how you're not locked into a rate on your home specifically. And I think this is going to mainly affect investors and the investing market on real estate that's happening right now, because you can see all prices across real estate are skyrocketing nationwide. And this comes right back into inflation. And that's why I think this is such a massive problem, because you're going to be sitting at these extremely high ranges on the yields for some time. And when you were back here with all those rate hikes and things like that, you were only here for so long. But if you go back to 05, look at how long you sat in that range in 06, going into 07 before the major crash. And I think that's what's going to play a toll here going into stagflation and really hurting the market. So going back to the Nasdaq and giving you a broad look of what's happening with hedge funds and what they're buying today. The first thing I want to show you is the CVD, the cumulative volume delta, and this just gives you a broad scale of what's happening with the market and where are buyers and where are sellers. And we saw yesterday it was pretty flat, whipsawing back and forth. On the day, you're massively down, which indicates you continue to get more and more selling pressure. Even on these pops that you're getting to the upside, the sellers just step back in and push you to newer lows. You've tried to find higher levels here, but it's looking like they still sit in control. So ultimately, in my opinion, I think it all comes back down to these monthly levels on the Nasdaq and on the S&P. So as you get in here, what I want to highlight specifically on the lower time frame chart, so you can see as you're looking at the market over the next few days, is can you hold this 12.9 region right here? I got to take away that resistance up there because this is going to be the highlight. If you remain above 12.9, I think you can still get some upside. However, if you stay below this region, you might just be on your way to find new lows, which is completely shocking based on no information really being released yet besides the job numbers, because you're starting to see a little bit more layoffs kicking in as well in the market. So if those numbers keep coming out and more data comes out to the downside, it's very easy. You're going to see this 1200 region on the Nasdaq. As far as the S&P, you got to hold this monthly as well. Again, this is your level. We can get rid of the key zone down here. And if you don't know what this key zone is, it's the March and February lows. That's exactly what this region is. So you can see this is the area you got to hold, basically 410 all the way down to 405, that new low that you made. But in my opinion, that doesn't even matter, because if you come down and you break below this monthly level right here, it's game over and you're pushing back down to 405 and most likely 400 as more and more bad data gets hit into the market. Now, this is just my opinion. Do with it as you will. Every single day I'm posting these videos giving you an update on the market, the fundamental aspect of what's happening in the economy, and how you should be looking at the market going into the next day. This is not financial advice. Do your own due diligence. I ask you to consider doing two things: hitting the like and the subscribe, because it helps out the channel so much. Have a good one, traders.